Good evening from Washington. John Boehner got 98% of what he wanted again today. The Dow Jones Industrial Average dropped 634 points today. It is the worst one-day point drop since December 2008. 98% of that drop would be 621 points, which, according to Boehner's claim, are assignable to him and House Republicans who say they got 98% of what they wanted in the deficit reduction deal, which preceded the sharp decline in the stock market that began last week. Skittish investors fleeing stocks rushed to safer investments, and as is customary during a stock market collapse, they rushed to the safest investment in the world, United States Treasury bonds. That's right. Shares of the federal government's debt are still considered the safest investment in the world by experienced investors on the first trading day after Standard & Poor's took the unprecedented political action of downgrading Treasury's long-term debt from AAA to AA+. The S&P downgrade was a purely political act taken by these two leaders of the confederacy of dunces known as Standard & Poor's. John Chambers is the managing director of S&P, and David Beers is the head of the Sovereign Credit Ratings Division of S&P. S&P has been egregiously wrong before, and they are wrong again. The downgrade was not based on some sophisticated analysis of the numbers. Indeed, S&P got the numbers wrong, very wrong. Friday afternoon, the Treasury pointed out to S&P that among the many miscalculations it has been caught making over the years, it had miscalculated our debt on Friday by $2 trillion. After S&P accepted Treasury's correction of its calculation, S&P went ahead with the downgrade, couching it entirely in political terms. The political brinksmanship of recent months highlights what we see as America's governance and policymaking becoming less stable, less effective, and less predictable than what we previously believed. The statutory debt ceiling and the threat of default have become political bargaining chips in the debate over fiscal policy. John Chambers, who lives in Manhattan, and David Beers, who lives in London, have no better understanding of the politics and policies of the United States government than you do. In fact, they obviously have much less of an understanding than you do, because they actually think that within the foreseeable future, the next few years, the United States government might actually default on its debt simply by failing to raise the debt ceiling when and if it's necessary. The statutory debt ceiling and the threat of default have become political bargaining chips. That's what worries them. I have told viewers of this program that we will always raise the debt ceiling. We always have and always will. What John Chambers and David Beers, the most incompetent analyzers of Treasury debt in American history, fail to understand is that the debt ceiling has always been a political bargaining chip. The political game in the debt ceiling just has never been played quite as loudly as it was played this year. Almost half of the Congress almost always votes against increasing the debt ceiling. The party out of power leaves raising the debt ceiling to the party in power. That's why Senator Barack Obama voted against raising the debt ceiling when the Republicans had a majority in the United States Senate. It's not that Senator Obama was really opposed to raising the debt ceiling. He was just playing a political game with it, trying to highlight Republican responsibility for the debt. This year, we saw something we hadn't seen before. Some Tea Party members of Congress claiming that they would do anything to prevent an increase in the debt ceiling, no matter what. It turned out, big surprise, a lot of them were lying, and they did in fact vote for an increase in the debt ceiling. In fact, last week's vote for a debt ceiling increase was the most bipartisan vote to increase the debt ceiling we have seen in a very, very long time. But still, the incompetent, politically illiterate John Chambers and Londoner David Beers offer as the basis of their utterly wrong downgrade nothing but the political worry that maybe Congress won't raise the debt ceiling the next time it has to. They will be proven wrong every day for the rest of their lives, because the United States government, including the Congress as currently constituted, will never fail to pay its debts. And last week, it proved that yet again. It proved it despite the utterly insane rhetoric of the Michelle Bachmanns of the Congress, who John Chambers and David Beers regard as having something very important to do with our governing outcomes. In fact, Michelle Bachmann has never once mattered in American government, nor will she in the future. You have to know something about politics to know that she's just one vote in the House of Representatives and her vote never matters. And John Chambers and David Beers, the stupidest political analyst in Wall Street's history, they don't know that. John Chambers and David Beers' ignorance is more dangerous and pernicious than the craziest of the Tea Partiers. The ignorance of these two men and of the rest of S&P has already done more damage to this country than the most inane Bachmann utterance about American history ever could. They are a disgrace to their occupation, which does not deserve the more elevated term profession. I leave it to you to decide if they are a disgrace to their country. We have been struggling during the Obama presidency to emerge from the most crippling recession since the 1930s, a recession brought about in no small measure by the willful, wanton, reckless conduct of the dunces and, yes, perhaps criminals at Standard & Poor's. S&P and other rating agencies gave AAA ratings to mortgage-backed securities that turned out to be the toxic waste of Wall Street. Junk worth virtually nothing. S&P gave that junk the same value as the safest investment in the world, United States Treasuries. S&P gave Lehman Brothers an A rating right up to the month that Lehman Brothers went bankrupt. S&P was as wrong about Lehman Brothers as it is wrong about the United States of America. Congressional investigators looking into the causes of the financial collapse found this instant message exchange between S&P employees. That deal is ridiculous. I know, the model doesn't capture half the risk. We shouldn't be rating it. We rate every deal. It could be structured by cows and we would rate it. One S&P senior manager put this in an email to another senior manager. Lord help our effing scam. This has to be the stupidest place I have worked at. S&P is the stupidest place everyone at S&P has ever worked at. And these two, John Chambers and David Beers, have now taken their places as the worst political pundits in our midst. Joining me now, former Labor Secretary under President Clinton and now Professor of Public Policy at the University of California at Berkeley, Robert Reich. He is also the author of Aftershock, which is now in paperback. Thank you very much for joining me tonight, Robert.
Good evening, Lawrence.
The Standard & Poor's rating, as I read it, is nothing but a political adjudication made by people who know nothing about politics and who also happen to have an absolutely horrific track record at doing what they're supposed to do for a living. What am I missing here?
I don't think you're missing anything. It's actually extraordinary. I mean, here we have Standard & Poor's charging into the political arena in a way that is so unique with regard to ratings agencies. I mean, granted, they did a lousy job on what they were supposed to do, and that was rating Lehman Brothers and everything else on Wall Street. But when it comes to sovereign debt, what they should pay attention to is obviously the wealth of a country, the size of a country, the record of a country like the United States on paying its debts. Instead, they say that not only don't they believe that we are going to honor our debts, but in the future they say that we should get much more serious about, over the next 10 years, reducing our debt by a certain amount. We should have tax increases. We should cut Medicare. I mean, they are acting as if they are another branch of government, and that is totally inappropriate. That is not what they are authorized to do, and it looks like the market said to them today, well, we're rattled, certainly. The stock market was rattled. But if you look at the Treasury bill, the actual value of the Treasury bill, which is the United States IOU, it looks like markets said to S&P, essentially, we are not going to listen to you.
Yeah, the S&P's record is absurd. And you wrote something very, very important today, Bob, about Standard & Poor's falling down on the job in the past actually is part of what got us into this debt situation.
Of course. You know, Lawrence, if you actually look at the record, had Standard & Poor's and Moody's and Fitch, the three major credit rating agencies, had they done their job in the in 2005, 2006, 2007, had they rated all of the junk that was coming out of Wall Street, not just Lehman Brothers, but everything else, the credit default swaps, the AIG, everything else, had they rated them what they should have been rated, and that is way, way below what the ratings they got, because they're paid from Wall Street. I mean, that's where their money comes from. So obviously the issuers don't want to have bad ratings, and there's a conflict of interest. Had they done that, we would not have had the huge debt bubble, the housing bubble. When it burst, we would not have had the huge Great Recession, the scale of which required the government bailout of Wall Street, a stimulus package, a lot of things that are now contributing to the debt we have today. So it's a double irony. Not only is Standard & Poor's not doing the job it ought to be doing today, it didn't do the job it should have been doing then, which got us into the trouble we are in today.
Robert Reich, former Labor Secretary, thank you very much for joining me tonight.
Thanks, Lawrence.